My name is Jack Hanney, and welcome to this week's edition of The Insider. The Fed is warming up the printing presses. Last week it was mentioned that there would be an end to the quantitative tightening program well before they had shrunk the balance sheet, which initially they were looking at $6.6 trillion. They are only $2.2 trillion into shrinking the balance sheet through the quantitative tightening program, and they will be discontinuing that program. So it starts with rate cuts, which we saw at the last two Fed meetings, with the Fed's cutting rates a quarter basis point in each of the last two Fed meetings. Then quantitative tightening, the discontinuation of quantitative tightening, and then what follows is quantitative easing, the destruction of currency and the printing of money. This is due to the labor market, which is absolutely destroyed at the present. The labor market right now, despite the Fed not being able to receive government data due to the government shutdown, along with Americans searching help with my mortgage, is at the highest levels, surpassing even 2008. So think of that. Americans right now searching help with my mortgage is at levels surpassing 2008 and the subprime mortgage crises. I was at the grocery store over the weekend, and a bunch of asparagus was $9.99. 3 heads of romaine lettuce, $8.99. So the Feds are cutting rates and about to initiate quantitative easing in 2026 at a time when we see persistent inflation right now with food prices. If you look at beef prices, those two are also skyrocketing. So what are we looking at going into 2026? Many are drawing parallels in the stock market to 1929. It certainly looks like this is an AI blow-off top as we near the end of the year here in Q4. So again, Aaron Ross Sorkin was on 60 Minutes the week before last, drawing the parallels of the stock market to 1929. Meanwhile, forecast for gold, Goldman Sachs is standing by its $4,900 an ounce forecast. Bank of America raised its forecast to $6,000 an ounce. Jamie Dimon said gold could easily go to $5,000 or $10,000 an ounce. And JP Morgan said the metal could easily double. So again, I've mentioned before, gold surpassed its inflation-adjusted all-time high a few months ago when it surpassed $3,500 an ounce. Silver always follows. Silver's inflation-adjusted all-time high is $209 an ounce. So going into 2026, retail investors are looking into physical gold. I am not a certified financial investment advisor, nor do I give tax advice. Please visit us at www.patriotgoldgroup.com or call 1-888-488-5190. Again, that's www.patriotgoldgroup.com or call 1-888-488-5190. Again, Americans searching help with my mortgage has surpassed the levels of 2008, and the labor market right now is crashing. So protect yourself with physical gold and silver. I look forward to speaking with you next week on an episode of The Insider.